Welcome, Rain King members. It's John at Rain King Insights. And I also want to welcome the broader public for the once a month free access video, which is on my YouTube channel. This is the general market update for Friday, September 26, 2025. What a tough week it was in the market if you're a growth stock investor. So let's break it all down. Before we do that, let's just remember that all of the videos by Rain King LLC are for educational purposes only. And before we dive into the main attraction of the general market, I just wanted to let people know that we've just released a brand new series called Mastering Exits with Sell Rules. It's a three-part series. Volume 1 covers offensive sell rules. It's an hour-and-a-half video. And Volume 2 is defensive sell rules. Again, another hour-and-a-half of content. And Volume 3 is called Situational Awareness Selling. This is really more about the art of selling, basing on your decisions more on your experience and the market conditions. So it's a great series. It's a great time to join us at Rain King Insights. I'm making a special weekend coupon code called Make It Rain. And if you use that to get an annual membership at Rain King Insights at any level of annual membership, you'll get 10% off at checkout. There's not a better time to join us than right now. The coupon's good until Monday at midnight, so don't delay there. Also, if you want, just subscribe to my YouTube channel using the little icon in the lower right-hand corner. That way, whenever I post anything for free on my YouTube channel, you'll get a notification of the new content. All right, let's get into the main attraction. That's the general market. We're going to go over the indices, then we're going to go over some positioning, what's going on with sentiment, and then we'll have an educational session on portfolio management. You know, is this a time that we should be patient or should we be taking action? And then we'll look at some names that are showing relative strength that looks like a pullback is beginning, and then we'll put all the pieces of the puzzle together. All right, let's start with the indices and look at a couple of things. Let's start with the NASDAQ. So this is the NASDAQ on a daily chart. Try not to get distracted by all my notes, but I'll take you through this. There's a lot of information here, but we're going to go through it kind of clockwise. So this is the NASDAQ as a candle chart. In the upper panel, this is the percent of NASDAQ stocks that are above their 50-day moving average. And it's really stalled out. You'll notice here that even as the NASDAQ here is making new highs, the number of stocks above their 50-day is deteriorating. And it's really peeled off this week. So that's not a good sign. Number two, my pullback warning indicator, which I've shared before, on Monday flashed that we were getting stretched in the index, and then we probably could expect some pullback. And that seems to be pretty much on time with that particular warning on Monday. Now, also, a new development. Last week, we had one very mild distribution days, and we've had two distribution days this week. So now this is starting to look a little more concerning. We've got 3 distribution days in the past 8 sessions in the market. You know, usually when you get to 4 distribution days in 8 days, that's really a flag to slow down. So we're getting closer to some clustering effect here. Now, on Wednesday, we actually had a bad candle. We had a 3-bar break down, and we've talked about 3-bar breaks that we want to see a recovery of at least half of that candle within a number of days. So I've drawn the midpoint here of that candle, and you can see we came down further. We got close to the purple line, which is the 20 exponential. We bounced a little bit today, and you can see that we don't know if this midpoint, sometimes this 3-bar break midpoint can act as resistance, and maybe we're going to go lower. So if we were to turn and go lower, I've just marked a couple things here to kind of anticipate what a pullback might look like. You know, we could actually come down 4.3 to 5.3%. And the reason how I got there was, if we just look at this little consolidation here, the top of this consolidation is about the 4.3% pullback. And then if we go further, we'd be down to the 50-day moving average in red, which is about 5.3%. So all of that would be a completely normal pullback. Might not be easy to experience, but it'd be normal in the characteristic of a bull market. So who knows, maybe on Monday we ratchet higher, but given some of the signs of the waning breadth of the market, distribution days, It seems right now the odds favor pulling back a little more. Now, if we switch to the S&P 500, again, we have waning breadth above the 50-day moving average. You can see here, this pink line is the stocks above the 50-day in the S&P, and you can see it's a steady decline since late August. And you can see, which also is concerning, is these divergences where we're getting new highs in the index, the S&P, yet we're getting less numbers of participation and breadth. You can see the new high that we had on last Friday. We even got less numbers, and we've really peeled off again down to 47%. So not a good look. It's telling us that the broader market under the surface is weaker than the indexes. Now, if we look at this week a little bit closer, we get more insight to what's happening. So I've taken these the past week of candles, and I've blown this up really big. And I just wanted to kind of play back the week. Here we are, Friday, Thursday, Wednesday, Tuesday, Monday. Well, last Friday is when things started to look peculiar to me. And the reason being, we had an up day in the market. Now, we had an up day, but if you look at the breadth numbers last Friday, it was actually decliners led the advancers by 2 to 1, almost 2.1 to 1. So that's what I call a bad up day. We would expect advancing issues to be higher than decliners when you have an up day, particularly when you are at new highs in the index. So that was a concern. Then we had another move up higher, and you can see the breadth was neutral. We still didn't get any advancers outpacing decliners, even though the market was moving to new highs and the volume came down. So neutral breadth, again, not great. And then the last couple of days, we're seeing strong decliners in the breadth. We're seeing 1.1, 1.7 decliners to every advancer. And even yesterday, we have 2.7 declining issues for every advancing issue. So it's gotten worse all week. We're bouncing today. I don't know the final numbers on the advancer declines, but we'll look at that over the weekend and break it down. But you can see this whole week has not been a great period for the market. All right, let's go into the S&P from a little different angle. This is a chart from Macro Charts, and this is looking at the S&P. How many days does it go before, without having a 1% decline? This is a couple days ago, but we were 34 days into this without having a 1% drop in the S&P. And so what this chart is doing is we've got the S&P in black. It's showing the number of days between 1% declines. You can see 38, 52. Sometimes we go under big, long stretches without a 1% decline. So you can see this kind of blue band here, which I've kind of drawn a box around. We're at 34. We're in the range where we might get a 1% decline, which actually would spike some volatility and make it a little more treacherous in the market in the short term. So let's see how it plays out, but maybe we're getting close to being due for some of those 1% declines. Now, I put this on my X feed yesterday. This is actually looking at the 1995 NASDAQ to 2000, big bull market. And what was interesting was in 1996, December 5th to be exact, Fed Chairman Alan Greenspan made a speech, and he said, boy, the market, there's a lot of irrational exuberance in the market. At the time, the NASDAQ was at 1,312, and he made that speech. And, we all know the next 3 years were basically a very strong bull market. Now, it didn't escape any pullbacks. And there's a pullback here. There was a mini bear market in here in 1998. So it wasn't completely smooth. But from that point, the NASDAQ went up another 294% to March of 2000 when we actually peaked. So if we look at this today, here's the NASDAQ going back to 2023, which really was the start of the new bull market. And then we had the tariff mini bear market here. And then just recently, Fed Chairman Powell said, he mentioned that stocks were referred to them as fairly highly valued stocks. So who knows, maybe this is Powell's Greenspan moment. The market right here, this is 22,537 and change on the NASDAQ. And if we were to go another 294% in this bull market, believe it or not, the NASDAQ would be up somewhere around 65,000, which sounds really, really crazy. But who knows? Maybe by this bull market marches along for another 2 or 3 years, we could get to 65,000. So we don't want to predict. We just want to watch the price and volume of the indexes and the leading stocks. Now, breaking it down a little closer, this is the 96 market, right when Alan Greenspan made his speech. And you'll notice that immediately the next day, there was some volatility here. The market dropped 3.4% intraday, but then it got some support. Then it came back and it faded down another 3.8 with a little pullback. So it was a little bit of short-term turbulence, but then the market tried to make its highs towards the end of the year. And in January, though, we did get at 1997, early in 97, we had a meaningful correction, which you can see here on the line chart. So we don't want to predict where we're going to go, but I will say, here's a great quote. I showed this a couple of weeks ago to our members, and it's from Frank Gretz, who's a technical analyst at Wellington Shields. He says, "They say you never know a bubble when you're in one. And if you think you know, invariably you're early. And being early is the same thing as being wrong." So if everybody's running around saying we're in a bubble, the market's going to collapse, you're probably early. So let's just take it one day at a time. This market might go a lot further than anyone thinks. All right, let's move into topic number 2, which is positioning and some sentiment. All right, this is the equity put call ratio as of a couple of days, really trying to understand sentiment. So this is the put call ratio line. And just to orient you, if you're below the red line, that means people are buying lots and lots of calls and nobody's buying puts, which means everybody is very, very bullish. If you get above the green line, that means everybody's buying puts because they're very scared and there's a lot of fear in the market. And you can see there's a lot of fear in the market, people buying puts when the market is bottoming. This is actually the bottom of the tariff bear market. And you can see here, currently, there's heavy call buying going on, which really is speculators are putting a lot of risk on buying calls. And that's why the reading is so low. We haven't had a reading this low until we go all the way back to mid-December. And if you recall, mid-December is when the market got completely choppy and it flattened out. You can see how choppy it is in here. And, the sentiment actually came back down again where it was very little put buying. And that's when the market rolled over. So this is, we don't know how this is going to play out. But it's certainly showing not much fear in the market, a lot of complacency. And usually that needs to correct itself. And given what we're seeing in the breadth numbers, those are giving us kind of the same message that maybe a pullback of some degree is be happening. And maybe it would be actually healthy for the longer term of the market. Okay, switching to S&P positioning. This is from macro charts. This is looking at the S&P futures positioning of asset managers and hedge funds. In general, the two lines stay in sync. This is the S&P 500, and you can see positioning generally follows the index. Now, we've been seeing a lot of divergence since the tariff bottom here. The market has come back very, very strong, but yet positioning of S&P futures has really gone sideways. And we said maybe there's going to be a big catch-up rally. It hasn't really happened yet. We've had a little bit of a bounce. And what's really kind of a head scratcher is the market's up here making highs, but the breadth is deteriorating and positioning is turning the other way. So, is this a concern that professionals have about the economy, maybe the impact of tariffs that are coming, or maybe it's just renewed fears that inflation is going to reignite. But it's a very big discrepancy here. So we'll keep our eye on this. But right now, it's definitely a head scratcher. And again, another chart from macro charts. This is looking at United States speculative option volume. And keeping this very simple, when you get to very extreme levels of call buying, it can happen at market peaks. Look how high the call buying and option buying was right around the meme bubble that was in February of 2021. So it got really high there. And then eventually the market top in November of 21, the speculative call buying was very, very bullish. And you can see right now, we're just starting to cross that line. When we looked at the equity put call ratio, it's giving a confirming that the two are saying a similar message. Now, it's interesting to note that the meme bubble call buying, gross stocks at that point topped out, but you can see that the general market didn't. The general market continued to move higher and the call buying came down, but growth stocks were really topping out and cyclical stocks were starting to lead the market. Then eventually when the market topped out, the speculative call buying came down, and that's when the market really started to roll into the 2022 bear market. So we don't know what's going to happen here, but let's just keep our eye on it. There seems to be a little bit of cooling that needs to happen to kind of reset as we go into the fall. Now, most want to talk about the Russell 2000, the IWM. Again, this is positioning. We've talked about this a couple times over the past month. There's heavy short interest in the Russell. And over the last few weeks, there's been some covering of those short positions, but nowhere near what you would think. You can see here the Russell is almost at a 4-year high, yet still a lot of shorts out there. So maybe that's fuel that's going to add to the Russell continuing to lead, and small caps continuing maybe to push and lead the market for a while. It's probably dependent on interest rate cuts, and right now the economic data is very mixed. There's a case to be made that we should have more cuts, and there's a case to be made saying we got to be careful about cutting too fast. So the Russell is interesting dynamic going on. Now, as a side note, this is a chart, a little bar chart showing that in Q4, okay, the Russell does pretty well. Now, this is a very limited sample size. It's, not limited, but it's, it's 20 years, and it's showing that generally small caps do well in October, particularly in November, and December, they kind of back off. So all I'm trying to show is that maybe the seasonality of the market for small caps is going to have a tailwind here. So let's just take it one day at a time. Okay, let's move into topic 3. This is a little educational segment on portfolio management. The question really is, with the market pulling in, should we be patient with positions, or do we need to take a lot of action here with positions? So let's break this down a little bit. And before we do that, I've showed this September data. I just wanted to kind of conclude September. We've been watching this over the month. Everybody knows September is usually a weak month. And particularly the last week of September can be treacherous, really, because a lot of it's window dressing. We're at the very end of the quarter, and a lot of portfolio managers are selling winners, and they want to show things on their books a certain way. So since 1950, the S&P in this particular week is typically down 1.7%. It looks like we're going to close about 0.8 for this week this year. So we've done a little better this year. Same thing with the NASDAQ. NASDAQ, typically this week of September, it's down 2%. It looks like we're going to be settling in around 1.3%. So it's actually better. And the IWM, which typically this week of the September gets whacked almost 3.2%, we've done better, 1.7. It's a decline, but nowhere near some of the historical data. So interesting. And I think that probably more optimistic is to look at the seasonality of what we're moving into. We know that probably from mid-October to probably January is a really strong period for the market. So hopefully that's going to play itself out, and we're going to get a nice rally over the next few months, maybe, but it takes a pullback here to reset things before we can have that powerful rally. All right, back to portfolio management. It's very important that you have a daily routine. If you don't have a daily routine, you need to set one. Those of you that are members, I have a whole video about things to consider, especially busy people. How do you come up with a routine that is efficient and can get through all of looking at your stocks? And also, it's important that you look at the general market every single day to pick up on the clues of where the market might be heading, and do you need to make any adjustments to your portfolio. And if you do see a number of things signaling that conditions are changing, and we are seeing that right now, You have to be able to react with your positioning in your stocks. You might need to do a number of things. The question is, what do you do and how do you do it? So let's keep in mind that we trade growth stocks, and growth stocks are more volatile than the index. And Bill O'Neill did studies that growth stocks are going to correct 1.5 to 2.5 times what the NASDAQ index does. So if the NASDAQ corrects 5% that I was just showing on a couple slides earlier, that means your stocks potentially could correct 7%, 7.5%, or 2.5 times that. So you could be up around 10 to 12% correction in your individual stocks. So that's nothing to just shake off. You have to be aware that you're trading things that are much more volatile than the index. So you always have to put risk first. We want to be very, very conscious of managing risk. And that's why when we're developing our daily strategies, we're always saying we've got to come up with a defense plan first. Don't have to play offense first. We want to play defense first. We want to protect the downside. We want to make sure that our portfolio has some protections in it and we're making the right moves. Now, those of you, and I know many of you like these 3x levered ETFs in the technology sector, and sometimes you want to pile in a lot of your portfolio into one sector, such as semiconductors or cybersecurity stocks. You just have to be very, very aware. If you do this, your pullback is going to be much more than 1.5 to 2.5 times. You could be looking at 5, 10, 15, 20% pullbacks if you are over levered in a lot of levered ETFs. So please make sure you know what you're in and if you're comfortable or not taking those risks, because you can get hit hard when the market starts to pull in. Now, there's a couple things we want to be very mindful with risk. The first thing is we want to be very mindful of open portfolio risk. And that's looking at all of your positions, and you want to calculate if all my stop losses that I have placed, if they're all hit on the exact same day, what would be the drawdown in my portfolio? How much would I be giving back? You really want to know that. And most people know what the individual risk they're taking on a stock with a stop, but they don't look at it and say, well, I own 7 stocks. What if they're all hit at the same day? So you can get hit in the face. And if you know you're taking too much open portfolio risk, you know you need to take some action. The second part of this is just generally how much of your capital is in the market? How much exposure do you have in the market? That's the percent of your portfolio that you have currently invested. If the market's pulling in, you probably don't want to be on margin. You want to be less than 100% invested unless you have huge cushions. So you want to know both numbers when you're thinking through what's the right move for your portfolio. Now, if you notice the market is pulling back, you're going to have to make some adjustments. If you have too much open portfolio risk, one of the things you might consider is just simply raising your stops to try and tighten up the open risk. If you had 10% risk, open portfolio risk, and you say, well, that's too much, then I'm going to raise some stops in case they're all hit. I want to reduce that to maybe 7% of my portfolio or maybe 4% of my portfolio. So you need to think that through. Now, if you're going to raise stops, or maybe you're outright going to sell some weaker stocks, which ones do you consider for selling? I think very simply, you would probably target the names that you have little or no profit cushion. If you got no profit cushion, you're only up 2, 3, 4%, and the market pulls in, those profits are probably going to evaporate very, very quickly. So you might want to either just take the little gains or raise the stops right to break even. That way, if the market peels off, you're not going to take losses. Also, if you've got non-performers, if you have 6 stocks and they're all kind of moving up, but 1 or 2 of them have just been moving sideways and really, really underperforming, you might want to consider that one to raise the stop on that one because it's just not a performer. So you always want to check the relative strength line of all your stocks against the market and sometimes against the sector, as we've done in the membership before. So that's a little bit of some adjusting that you may need to do when the market, particularly if a market's going to pull in. And the real strategy here, if you're a position trader, is you're trying to make these adjustments I just mentioned because you're trying to protect the biggest position you have that has the biggest gains. If you have a 20% position or a 15% position and you're up 30, 40, 50%, you want to try and protect that so you don't get to have to puke it out when everything in your portfolio is red on the day and you get scared. You've worked probably very, very hard to try and build up that position by making 1, 2, 3, or 4 buys. And you've got a good position, you've got good average cost. So you don't want to be selling it in a panic just because you see a lot of red with other names in your portfolio. This is the position that you probably really, really want to be disciplined and say, I'm not selling this stock unless it triggers my sell rules. So therefore, you have to have sell rules. So that's a whole story in our Mastering Exits with Sell Rules series. So it's totally appropriate to be brushing up on your sell rules. All right, let's take a quick look now at a couple of names showing some relative strength in the market, and they might lead you to investigating some sectors or some individual names. There are some names that are still holding up quite well, showing extreme relative strength as the market is weakening. Robinhood has come down a little bit, but it's still very, very strong above a breakout level. That's been showing good relative strength. You can see Katos here. This is a defense stock. You can see it's actually broken out and it's got good follow through. And look at the RS line. We're at a new high. So that's very strong. Seagate, a lot of the memory stocks have been very, very strong. And you can see that even though Seagate has given back a little bit, you can see that it's doing it kind of begrudgingly. The volume is drying up. And you can see we've only come down really to the 10 exponential moving average, which is this teal line. So Seagate is hanging in tough. Nebius, which is the data center, hyperscale data center maker, they're doing well as you can see here. The relative strength line is still pretty strong, and you can see this gap up is still holding above the 10 exponential. And then Rambus, which is in the semiconductor area, a little turbulent getting out of the base, but had a nice surge. And again, you can see it's getting some support. So it's been acting pretty well, and the RS line looks pretty decent. Just for full disclosure, I have a position in Hood and Nebius. So these are a couple names you might want to look deeper into. Also, kind of off the radar is the energy stocks. Energy names are starting to perk up. Now, these are weekly charts, but they're worth taking a look at. This is Valero, VLO. You can see this is a longer weekly chart, but it formed a nice cup and get a nice breakout, and it's approaching all-time highs. So Valero looks pretty good if you're into energy stocks. Phillips 66, PSX, little cup with handle. You can see a prior uptrend, then we get a constructive cup with handle base, and it looks to be breaking out. And even Marathon Petroleum, again, weekly chart, little cup base, it's broken out, still got a ways to get to the old highs, but all of these look to be in newly established uptrends, and they're all kind of in the oil patch. So it may be something you want to keep an eye on. If you don't trade oil stocks, maybe they're not for you, and you just want to basically, if you're a growth stock investor, just stay to the sidelines for a little bit and monitor your current tech positions. All right, let's put the pieces together. So where are we? We are only about, roughly 2% off the highs. So the market's come down a little weak. It's been a kind of a tough week if you're a tech stock holder. It's been real. Some stocks have gotten hit, but the indexes are only off a couple percent. We're still above the 20-day currently. The power trend is still in place, which means we're in a strong uptrend. So that's all positive. New highs and new lows. Just yesterday, the NASDAQ reached net new lows. So that's a little bit of a concern. So I think it's going to be important to watch the next rally we get in the NASDAQ. Like I said, I'm going to watch that 3-bar break carefully. And if the next rally can show net new highs, that would be very positive. If the next rally up gets rejected and we keep getting net new lows, that would be a signal that this pullback is probably going to go deeper. So keep an eye on that one. The leading stocks, I mentioned before, we've had 3 distribution days on the NASDAQ in the past 8. That's definitely a yellow flag of caution. We don't like to see 4 or more clustered together like that. So we'll keep an eye on that. Now, some of the tech leaders have gotten hit pretty bad this week. A-Lab was a pretty big disappointment, really got hit hard. Credo, very similar nature of their business. Reddit got hit by some selling this week. But as I mentioned, there's still some other stocks that are showing extreme relative strength. NBIS, Hood, Seagate, AppLovin, Celestica, ANET, AVAV, and Katos are just naming a few of them that you might want to look into. So the exposure levels in the market, I'm bringing it down. We had a number of stop outs in the membership this week. Very frustrating week. We put a couple positions on, and within 1 or 2 days, they were stopped out. So there's been some selling going on this week. So I see the exposure levels being reduced by 25%, back down to 60 to 65% in the market. Again, tech was getting a little bit stretched. And the most important thing is we're listening. We are starting to get negative feedback from the market and negative feedback from our positions. When you take a new position, you're stopped out in 1 or 2 days, that's negative feedback. And that's a clear sign that you need to back away and slow down your buying and really, really take inventory of how you're going to protect your account in case things get worse. So raising some cash is not a bad thing. If you raise some cash here and you end up with 30, 40% cash, when the market gives the clear signal that we are going to move higher and the breadth of the market improves, you're going to have buying power because you're going to have some cash from stocks that you let go. And when the market firms up, you'll be really ready to either add to existing positions or redeploy in some new buys. So again, as a position trader, if you have some big winners, you should be trying to hold them because you've got good cushion. Now, if you don't have big leaders with good cushion, anything with small gains, you're probably going to want to cut those losses very short, very quickly until we see how this pullback really, really plays out. All right, let's get to the quote of the week. It's from Joe Granville, who was a financial writer. As soon as you think you've got the key to the market, they change the lock. Now think about this. In the last 2 weeks, there's been a lot of tech stocks that are really driven higher and they looked really, really good. And some of you might have thought, boy, I got this game licked. I'm making a lot of money. Well, sometimes the market will punch you in the face as, the quote, change the lock. And just when you think you're smart, the market will make you look stupid. So we want to be very, very reactive, clue into what the market's doing. We're getting negative feedback. So the message really is slow down. Again, I just wanted to put this out there for those of you that might want to join us at Rain King Insights. Use the coupon code MAKEITRAIN at checkout and get 10% off an annual membership. This coupon's good till Monday at midnight. This is a really, really great series. It's a 4.5-hour series, pretty comprehensive, and it's available to all members of Rain King Insights. All right, that's the general market update for September 26th, 2025. Have a great weekend, everybody. And we'll see everybody, all our members. We'll see you at the focus list video on Sunday. And other members, we'll see you at next Friday's general market update.